But let's just start with this change. I mean, even when you look at the Journal headline from this morning at 7 a.m., futures not looking so good.
Right.
We're heading into another bad morning potentially as a result of the increase in hostilities in Ukraine, unfortunately. Continued goings on in the bond market in the UK. Pick your poison. What happened?
Well, first of all, it's a holiday, so bonds can't hurt us. Bonds have been hurting us. Second, Friday's reaction to both AMD's pre-announcement, I don't know, it was really lingering on Friday, and to the jobs number was so negative as to almost build in, say, another 50 basis points. So people are now talking about 4.25, 4.5, maybe 5. The 2-year tells you that it's going to be 5. I mean, because 2 years is going to continue to go down and pricing up yield. So then you start thinking, well, if it's only going to be, say, 5, then maybe it's not the end of the world if it's done slowly. And what a lot of the commentators were saying today, we're done slowly but getting there, and that's a lot better because that's less catastrophic.
Right.
So look, I mean, what I'm basically saying is it's real bad, but it's not so bad as to be too. I know. It's not
we don't
so
really
bad.
know why the future's turned around,
No.
and who knows what the rest of the day will bring anyway when we start trading 27 minutes from now.
Think about it. This morning at 4, what was the theme? Well, okay, so Britain's panicking. All right, so Russia's really stepped it up. We're really stepping up against China.
Causing even more carnage, yes.
Ford's going to miss the quarter. It got that one very early because it's a European call.
UBS, you mean the downgrades?
Yeah,
we'll get to that.
We got the Procter downgrade, which was vicious and horrible and mean. That's because my child trust knows it. And you come back, even Bristol Myers was downgraded, Dave. That's not supposed to happen. Guggenheim. So what you come back to is perhaps it's another one of those sentiment moments where you had a trilogy here. You got the CPI, the PPI, and then you have the jobs, but the jobs is far away. Is it really possible that one of those, that all three are going to be bad? Were last time. What happened to PPI? It's not so bad. So I think people are betting that the first of the three might be okay, based on the fact that we don't have to worry about the bonds today.
But we are going to start to get earnings. We just looked at
and remember,
a
it's the one
graphic,
good part.
Pepsi, and then obviously a number of others, and then the banks later in the week. Jim, there are still those who believe that S&P earnings are going to come in next year below 200, that we're going to start to get the guidance that apprises the market of that fact, that we've had demand destruction from rates that we haven't seen the end of yet. The wage increases that we've talked about are still coming through, not to mention expenses are higher in general. People are traveling again at companies, for example.
The balance sheet of America has got, I was reading a Quartz article today, using St. Louis Fed. The balance sheet for individuals is now lower than 2008. You signaled that to me last week when you said that the consumer's more strapped than you realize going into a possible recession.
Right.
That's extraordinary.
It is. And so you can, there are those who still want to make a case for the fact that if you apply a 15 multiple in the S&P and you really think we're going to get a number for earnings next year that's around 200, we've got a lot more downside.
We know that going into a down year is a clarion call to raise cash. We know that cash is giving you a great return. So all you can really hope for as your bull is that the price target cutting stops and that the industrials have stimulus money from actual building of things. But, David, you don't have anything related to PCs or cell phones, and you have nothing related to China. That's a big chunk of the market that is a hole in 2023 earnings.
Yeah. Shepard Smith here. Thanks for watching CNBC on YouTube.